Good morning, traders, and welcome to the live stream. My name is Charles Gough. I come from a community called Pirate Traders, where we are focused on the ES, the NQ, and how they move through the two-way auction process. And boy, what an auction we have. All right, so I'm going to take a quick minute here to kind of dive into what was happening 2 weeks ago, what happened last week, and then what I think is going to happen this week. So a couple weeks ago, we were pinned. The market was going sideways in a range. Okay, let me just drag this over for a second. So you can see, we were just stuck in this range going sideways for weeks and weeks and weeks. We'd start going up and we'd come back down. We'd start going down and we'd come back up. And so we called that pin 6840. That's sort of the central level that we felt like that's where the pin exists. Okay. The further we go away, the more likely we come back. And that just kept happening over and over and over again. Well, last week, the market finally broke away from that pin. So the pin is something we call balance. It's the market going sideways. And the market can only go sideways for so long. At some point, it's got to move to a new location. That's what we call a breakout of balance. When you break out of balance, you create momentum. What is momentum? Momentum is that couple of days in a row where the market just kept making higher highs and higher lows and higher highs and higher lows all the way into Friday. Okay, so the market had balance, then it got momentum. Well, what do you guys think happens when you run out of momentum? You get more balance. That's just the way the market works. It goes momentum, balance, over and over and over again. It's a cycle that it just keeps going through. And it does this whether you're looking at 1 minute candles and you're asking yourself, what are the changes minute by minute? It does this if you're looking at hourly candles, daily candles, monthly candles, yearly candles. If you want to look at the balance and momentum over the last, 100 years, you can look at yearly candles to see it. But it is this process that the market always goes through. So as of the market close on Friday, we had momentum. Right? The market was still making those higher highs and those higher lows. Well, this morning, something has changed. And that change is the gap down. So we are set to open with a gap down this morning, meaning we are going to open below Friday's range. And that means that is the first sign that the momentum is over. It's the first sign that we've gone too far to the upside, and we need to balance it off. Now, there are two ways that you can balance off momentum, right? The first way is you can balance with time. That basically means you just go sideways at a higher price. That is balancing with time. The other way you can balance off momentum is with price. You can pull back with price. Those are two different ways that you can balance momentum. And this is essentially all we care about this morning. Today, we're asking ourselves the question, we know the momentum is over because we've got the gap down. So the next question we're asking ourselves is, how is this market going to bounce? Is it just going to go sideways at higher prices, or is it going to pull back with price? Are we going to get a big dip because we've run out of steam to the upside? Now, I'm going to tell you something that is not based on market generation. It is just, my personal guess. I think we're going to balance with time. I think we're going to go sideways up here near the all-time highs. And the reason I think that is because of the fact that, there's sort of an unspoken rule in the world of Wall Street where they want the market to close at the end of the year as high as possible. They want all asset prices, no matter what it is, precious metals or whatever it is, right? They want every asset they can to be as high as they possibly can at the end of the year because their bonus checks are calculated based on their portfolio at the end of the year, based on what they've got on December 31st. So I suspect over the next few days, the market is either going to go sideways or it's going to make another new all-time high. Okay. There is absolutely a chance we could dip back down. We could even dip as far as back to the pin, 6840. I'm not saying that's impossible, right? Please don't hear me say that's impossible. But if we're going back to 6840, I think we would more likely do it next week or start to do it on Friday of this week. Okay. So my guess is we're going to balance with time. But the good news is you don't have to go based off of my guess. we can use market-generated information. So when I look at this chart right now, what is the market-generated information telling me? Market-generated information is information from the market. It's not opinion, it's fact. It's what the market did. Where did it go? How much time did it spend there? And how much volume did it bring in? Okay, so the first thing that jumps out at me when I look at the momentum that we had, so here's the pin down here. We broke away from the pin. That's our momentum. What do you notice? There's a shit ton of red in here, right? You see all these red levels? Now remember, the market closed up here on Friday. I didn't come back and mark these levels after the fact. These have been here since the close on Friday. Okay. And the way it works with these weak references is the more of them that you stack up, the more likely the market needs to dip back down and do what we call repair those weak references, which basically just means pass through them, right? Tag those levels and pass through it a little bit. And you can notice, at the beginning when the market had some momentum, we were just leaving behind a few weak references, not that much. But as that momentum continued, we were leaving more and more and more and more and more weak references, increasing the odds that the market needed a dip. So it should come as no surprise this morning to see a gap down. The market needed to clean up weakness. Well, at the very moment that the opening bell rings, we've still got 20 minutes till the opening bell rings, but let's say it were to open right where it is right now, we've just cleaned up half those weak references instantly. The moment the opening bell rings, because we've already passed through them, we've cleaned up all that weakness. We've also come back to back test the previous all-time high. This is really, really important. The market almost always, when it breaks out of an all-time high, comes back to back test that level. Okay. So this morning, we're back testing that breakout of that all-time high. That we needed to do. And now we've done it. We needed to clean up at least some of this weakness. And now at the opening bell, we're going to do it. So if you don't want to trust the market generated, or if you don't want to trust my opinion and you want market generated information, here it is right here. 69.44 and 69.69. These are the levels that will tell us, are we balancing with time or are we balancing with price? If the market opens this morning and it gets below 44 and we get new selling there, it means we need a larger dip. We need to head back down. We need to head lower. If the market gets back down there and then it repairs that weak reference, but reverses and comes back up, well, then maybe that tells us we don't need the balance with price. We probably need the balance with time. That's telling us the market probably wants to just go sideways. And then if it comes back up to test Friday's low, that tells us, is it just going to be one little dip or are we really going to spend multiple days? So essentially, let me play out how this could happen. Step one, market passes lower, gets below 44, comes back up, gets resistance around yesterday's lows. That's a sign we're going sideways with time. Market comes down, reverses back up and doesn't get resistance there. That means the momentum will continue. That means we're going to keep going. We're going to start making new all-time highs tomorrow and the next day and the next day, because all this dip was this morning was just to clean up this weakness. Okay. And if the market gets down there below 44 and it starts to get new selling, well, then that is bearish that it needs a larger pullback. Okay. That's telling us we're going to balance off with price instead of with time. So very simply put, I am focused on the gap this morning, the gap down. As long as it is a gap and go, I am bearish. So I'm bearish at the market open. And if the market comes back up and fills the gap and then it gets resistance, I'm looking for a move lower. If the market fills the gap and it doesn't get resistance, then I'm bullish to head back up to those all-time highs. Okay. If you're asking whether or not you could take a gap fill trade this morning, whether you could go long to get to Friday's low, you absolutely can. I would recommend that you don't jump into that immediately at the market open. I believe there's a very high probability that the market wants to come back and clean up 69.44. So if it were me and I was looking to take a gap trade, I wouldn't take that first impulse to the upside. I would rather wait for it to dip below that overnight low, and then I would take the look below and fail of the overnight low, targeting the gap fill. So remember, the gap is telling us before the opening bell even rings, the market has momentum down. Do you really want to fight that momentum? It's up to you, right? You could wait until you get some confirmation that it's a good idea to fight momentum, which is that look below and fail. Or you could just get long, hoping for the gap fill, but then you're gambling. Okay. Is there any questions on any of that from the chat? I feel like I took 1 week off and now I'm like rusty on live streaming. So if I missed anything or it was confusing, please let me know. Also, if you are watching this in the Bookmap Discord, you can always just head to the Futures-Charles tab and you can leave your questions there and I will do my best to answer them. Good morning to Laura. Blink1484. Crypto Rider. And Trevor. Good morning. Good morning. No comments from the Discord. No questions from the chat. What else is there to do? Okay, well, let's really quickly, we will just do the top-down approach. Again, this doesn't really matter as much today because to me, we're talking about very, very specific levels here. I also wanted to mention this, the 618. So I marked this level in April of last year, okay? This was the extension from the big, correction that we had earlier on in the year. And so we did it. Ding, ding, ding. I just thought that was funny. And I was thinking about it right here when the market was making those previous all-time highs. And I was like, I don't understand why we didn't quite get to that 1618. I was like, we were so close. It's crazy. And then, quick tag right before the end of the year. Does that mean the market's going to run out of steam and liquidate from here? Not necessarily, but it just means we have now fully fulfilled the potential momentum created by this correction. We've gone as far as the correction itself provided for that move. So for us to be able to keep going higher from here, and of course now we're talking longer term, over the months ahead, years ahead, for us to keep going higher, we're really going to need to bring in a lot of new momentum, a lot of new buying up here at the all-time highs. So that's just something to keep track of. All right, let's start by looking at the monthly chart. So if we look at the monthly chart, the last 2 months, or I should say the last month, the month of November, was a balance month. And now December is turning out to be a potential breakout of balance. So it'll really depend where we are in 3 days. If we open above the all-time high, then it is a breakout of balance on a monthly, which is very, very bullish to continue. If we close back below that previous all-time high, basically below where we're going to open today, so if at the end of this month, we're below today's opening price, then that is actually a sign that the monthly is still in balance, okay? Which is actually bearish. Take a look at the weekly. So same thing. Last week, we broke out of balance. We had been in a 3-week balance range right here. Broke out. And so we'll find out this week, based on how this candle plays out, whether we're going to get momentum over multiple weeks, if we're going to keep going higher, or if we're going to immediately go balance on top of balance, which does happen sometimes. And we really can't predict that yet. We're going to wait till the end of the week. And then, yeah, as I said on the daily, we had the momentum up. We had that, trend all last week. Now that trend is over because we're gapping down this morning. Derek in the house, good morning to you. Dom says, America, this thing. What is this thing? This is like Cowabunga, dude. Woo. Laura says, NQ, please. Let's take a look at the Q. Just for you. It's what we're going to do. Oh, man. Boy, the NQ is just in the most balancing range ever. Okay, let's look at this on the daily real quick. Yeah, see, this is messy for the Q. Okay, so it's the same thing as the ES where we talked about last week was momentum to the upside. Okay, but it was different for the NQ than the ES. The ES was balancing at an all-time high, and that momentum was like just enough to poke up and take out that all-time high. That is not the case with the NQ here. Okay, the NQ was just trending to a more recent high. They haven't even come close to that all-time high at 26,400. So this actually is a little more bearish, the Q, than the ES to me. I would say you really got to pay attention to the low from the 23rd. Let's see if there's still any gap left there. There is. There's a tiny little gap. Okay. Uno momento. Just let the data load. Let the data load. All right. So today your downside target is going to be 25,602. You just call it 25,600. That is your downside target. Once the market gets there, that's where you're going to get a better idea of what comes next. Because if the market comes back and fills this little gap, this little unfilled gap right here, also an extremely weak low, by the way. 2 days in a row, an exact low on the NQ. Jeez Louise. Very weak. So the market does want to come back and clean that up probably today. But that doesn't necessarily mean the market's going to have a much bigger sell-off. So I'd be looking for the NQ to test 25,600. And then kind of see what happens when it gets there. If as it pushes into the upper end of this range from the 19th, okay? Let me just zoom out a little bit here. So market opens, gets below that overnight low, gets some new selling, pokes down. As it starts to re-enter this range, watch what's happening with it. Are support levels holding or are they immediately breaking, right? So let's say you got a support level, you know, here's a good one right here. We'll call that 25,560, right? You got a support level. So does the market just come down and go boop and turn around and start coming back up? Or does it kind of grind on that level? Or does it just crash right through? Okay. Those are your three options. If you get the immediate bounce, probably this range is going to be support and you'll turn around and head back up for the highs again, or anyway, for the gap fill, 25,830, right? If you grind and grind and grind, you need to just wait and be patient because either scenario could happen. But if you come back down into this range and there's no support in there, it just kind of boop, 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 keeps going, then this market is heading all the way back down to those balance area lows, which would be closer to 25,050, you know, that area down there. So that would be very bearish if you do not bounce off of the highs from the 19th today. Keep in mind for the NQ, this is a very large gap. Large gaps often don't fill on the first day. So if you are going to take a gap fill trade, let's say, for example, the market pushes down below that overnight low. We talked about this for the ES, right? It gets down there, but then it turns around and it comes back up and there's no resistance at the overnight low. You can absolutely go long there as a look below and fail. And you absolutely should use the gap fill as the target for that long. But once it starts to move in your favor, I would definitely put my stop above my break even. Okay. Because the odds of actually filling the gap are slightly less on the NQ today than on the ES. So I would describe myself at this very moment as slightly bearish on the ES, but straight up bearish on the NQ. 9 more minutes until the market opens. Let me know if you have any questions. Anything at all. Juan says, big up from Colombia. Welcome. Laura says she's watching 550 to 580 on the queue. Yep. That's exactly what I'm talking about. That's the area to look for support, to look for a bounce. And if you don't get it, today, if we don't get a bounce in that area, the market's going much lower. But if you do get a bounce, you're probably coming back up for that gap fill. Just keep in mind, it might feel bearish, but they need follow through. They need new selling. They need to keep that momentum down going because of this Santa Claus rally mechanism that we're talking about. Dom says Bitcoin thoughts. Yeah, we got some time. Let's take a look at the corn. Bitcoin. Bitcoin. Ooh. Man, poor Bitcoin. Gold is going to the moon and poor little Bitcoin. It's going nowhere. Where you going? Nowhere. Okay. So having not looked at this at all for a week, let me uncheck that. Let me just point out some of these technical analysis tools that I had marked here on Bitcoin and what they mean and how I read them. Well, this first one is a channel to the downside, this blue channel. That's a sign of balance. Okay. And so if you can break out of that channel, that's the potential to start the momentum. We've been talking about balance leads to momentum, right? You go sideways for however long you need to go sideways, then you start to break a certain direction. So in that case, we have now officially broken out of that channel. We did it using time. We just went sideways. We were grinding and grinding and grinding so long, we broke out of that channel. So let me first off extend that so that if we re-enter, I'm aware of it, because that will be a very potent signal if we re-enter that channel. Okay. But then what was the other thing I had marked on here? What is this blue box? Well, this is our horizontal balance. So this is what we call a balance area. Sometimes the market just gets stuck in a range where it has to go sideways. And there really doesn't have to be any deeper explanation than that. It's just stuck inside that range. And until it can get out of that range, it's not going to make any big moves. So I would say as long as Bitcoin stays above 84,900, you could stay neutral to bullish on Bitcoin right now. But if it comes back down, okay, and it breaks out of this box to the downside, this blue box right here, it's likely to move down much lower. Okay. We're talking into the 70s. If it re-enters this old channel, which is the exact same level right now, if it were to happen today, if it re-enters this channel, it increases the odds it's heading down to the opposite end of that channel. So Bitcoin could become very, very bearish if you start to get back down below, like I said, we'll call it 84,900, right? You start to get below there and there's potential for a big move lower. In between now and then, I would actually be neutral to bullish because we are breaking out of this channel using time. That's bullish. And we're just stuck in a balancing area, which is not bearish, right? Because if you break out of that balance area to the upside, then you're going to get the follow through. So I would describe myself as neutral on the Bitcoin. I'm sure people are going to want me to comment on silver. Okay, so recognize that this has a lot to do with, macro type of things, more so than just charting patterns, right? Stocks and stuff like that, they don't change that much. So we use, charting patterns to kind of recognize those changes. This is a big change in the world that's happening right now. With China locking down its silver exports. So you've got the combination of that. That's a real world macro change, and all the hype and excitement. And, everyone's got a cell phone and can trade right from their phone. You start to get these sort of mania types of rallies. I don't sound very smart saying it now, but as of yesterday, my thought was this thing needs a big red candle to the downside. And we're getting that today. So keep an eye on yesterday's daily low. Keep an eye on, if you're trading the futures, 224,000. That is your sort of deal or no deal level. You stay above it, you're bullish. You're going to continue making new highs. You break below it, you need a dip, likely down to, 207,000, down to that area. Don't chase these things. Don't FOMO. And also don't fight the momentum. So at this point, you want to wait for a dip, a really big dip if you're going to be a buyer, or if you're a seller, you want to wait until a failure to keep the one time framing going, a failure to keep the momentum going. And so you're going to be looking for, a new low on the daily. Acido says, what is your general opinion of metals? I don't trade them. I own some gold in my IRA. It makes up like 5% of my IRA, but that's about it. I don't trade metals. Here's the thing. I end up having to explain this over and over again, and the market opens in 2 minutes. So we'll get to the price action in a moment. But everybody always chases hype. Everybody always chases like, what's the thing right now? And when Bitcoin is going through the roof, everyone's talking about Bitcoin. And oh my God, what about Bitcoin? And what do you think of this? And da-da-da-da. And when it's silver, they're talking about that. And when it's, a certain stock price, when it's Nvidia or it's, GameStop or whatever it is, people always chase the hype. They always chase the hype. But that's just not how I trade. I did back in 10 years ago. I was chasing hype, trading crypto. But nowadays, that's just not how I approach trading. That's why I trade the ES, because the ES functions relatively the same no matter what. You know what I mean? It's 500 companies, and they cover all the different parts of the economy. And so the thing kind of has just patterns that it trades to. So even if you have hype happening in one sector of the stock market, that'll help the ES go up, but it's not going to cause these major, crazy moves. And so what I've learned to do is to just master the behavior, the day-to-day, just regular behavior of the ES. Become an expert in how it moves. That's my edge. My edge is not chasing whatever is the new hypey thing that everyone's talking about today or tomorrow. And with those types of things, maybe you can make a huge return very quickly if you get lucky and your timing is right. But with what I do, it's bread and butter trading. It's day in and day out. I can come into this market no matter what's going on. Bull market, bear market, sideways grindy market, huge range trending market, slow market, fast market. Doesn't matter. I can trade it all because I've seen it all. Because I'm an expert in every possible way the ES can move. I can show up every day and I can find a trade. And some days are a lot harder than others, but I can always find something, right? So that's sort of my approach to trading. I just don't chase the hype anymore. It's just not worth it, right? Just for my personality, it's not worth it. Okay, so we opened with that gap down. That is bearish to see. It is a sign, first off, that the momentum up is over, which, as we discussed, tells us we're either going sideways or lower in the days ahead. So now our focus is, are we going to fill the gap today? Are we going to get back to Friday's low? At this point, because the first impulse move was to the downside, once we cross through the opening price, which is about to happen right now, that is the trigger to try to fill the gap, crossing through the opening price. Okay, that tells us the market wants to try to fill it. If it cannot, if it starts to fill the gap and then it gets resistance and it comes back down through the opening price again, then it's a gap and go. And it's a sign the market wants to go lower. So that's the only question we're asking ourselves right now. Are we going to fill the gap, or are we going to get a gap and go and keep going to the downside? And we're watching how the market reacts, as it passes through this opening price to tell us. So we just had the first one, just right now. It poked through the opening price. What did it immediately do? It got smacked back down. So that's our first vote for bearishness. Doesn't mean they're not going to fill the gap. It's just we're starting to collect information. We're starting to build a narrative in our head. They want to fill the gap, and they're having a hard time. Let's see what happens. So first thing I'm going to do is get rid of all these old weak references that are now repaired. Okay, so we're back above the opening price. So we're back to trying to fill the gap. I'm going to mark some resistance levels. These are the levels that are going to tell us what to expect. Okay, so that's going to be 69.60 and 69.64. If the market holds the resistance there, okay, and then comes back down through the opening price, that will be very bearish and will increase the odds that we're heading down. We're really heading down to the overnight low at 69.42. If the market does not get resistance here, it's a sign we're going to fill the gap. And then we look for resistance at Friday's low. This is also the point where I'm going to start paying laser focused attention on the Bookmap chart. Okay. Bookmap is showing us order flow. So the chart on the left is a market profile chart. That is a price chart. Okay. It's the same thing as like a candlestick chart. It is showing us, price in 3 dimensions. So where does the market go in terms of the actual price level? How much time does it spend there? That's what the letters, the TPOs, show you. And then how much volume does it bring in? That's what the little volume bars are showing you. Okay. So that's time, price, and volume. And then over here on the right side of the screen, I got the Bookmap chart. Now this is showing us order flow. This is showing us where there are orders sitting in the order books right now. And more importantly than that, how they change throughout the day. If the market is doing something and suddenly something changes with the order flow, you can expect something's about to change with price action. So for example, right now, what does the market look like? We've got tons of support below. We've got tons of liquidity, just below the price, very little above. And the market is trying to fill the gap. It's trying to go up. So as we push up into resistance around 69.60, we're going to be watching for the order flow. Does it change as we get there? Do suddenly some of these levels start to disappear from below price? Do suddenly levels start to appear above price that are creating liquidity above? That would tell us that resistance is likely to hold and we're going to come back down. Or does that not happen? Do these levels below stay exactly the same and we keep thin volume above? Well, then our thin liquidity above. Well, then great. The market's going to go fill the gap. So the order flow is now very, very important. The other thing I'm watching for is the stops and icebergs, which really there hasn't been much of so far today, but that helps me understand who the participants are and what they might be doing. So as we push into resistance, do we suddenly start to get tons of icebergs, tons of red icebergs, right? That's sellers getting into the market. Or do we not? In which case there's no resistance and we fill the gap. Whoever just said hi back to you. Sorry, I can't read that name, but welcome. We're happy to have you. We got Trader in the Discord. Good morning to you. And Greenhorn Bull, welcome, welcome. All right, so here we go. We're going to test this resistance, and this is important. It's not just important to fill the gap or not, but it's important to give us context for what's going to happen today. We know the momentum up. The multi-day momentum is over. Okay? So now we need to find out, do we have momentum down? Getting resistance right now before filling the gap would be very bearish. Okay, so we talked about those changes in order flow. What is happening as we push into resistance? Are we losing liquidity below price and getting new liquidity above? No, we are not. So that tells us this market wants a gap fill. Okay, they want to get all the way up to 69.69. Bow, checka, wow, 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 wow. And that's where we will look for the resistance now. I'd actually say around 70 is where that resistance will be. And so now when we look at this order flow, we're asking the same question we were asking before. As we push into yesterday's lows, Friday's lows, we say, does the order flow suddenly change? Does liquidity below price start to disappear and new liquidity start to appear above price? What are we seeing? I literally just said it. What are we seeing? Liquidity disappearing below and appearing above. So that tells us they are going to turn this area into resistance. It is worth noting we have what we call a low volume node right around the current halfback. That is 69.57. So we're just going to mark that. It increases the odds that at some point today, the market is coming back to this level. Could be right this minute, could be 2 hours from now, but we're going to mark it so we're aware of it. Couple of low volume nodes, actually. Further increasing the odds that Friday's low will become resistance. Okay, so we talk about trade ideas. I'm just going to give you a trade idea purely for educational purposes. This is not, I'm not giving you a trade signal here. You're risking your own money if you want to take a trade. But this is the way I see trading and I see markets. I'm looking right now at the chart and I'm seeing probabilities. Okay, what is a high probability? One high probability, we're going to come back to here. Another high probability, we're going to come to here. We are probably both going to fill the gap. And we're probably going to come back to 69.57 today. Now, I can't tell you at this exact moment which is going to come first, but let's say I'm lucky And that first one is those low volume nodes. The market comes down first before it fills the gap. Well, why am I lucky if that happens? Because if the market comes back down to those low volume nodes, I know it's just coming back to backfill that low volume. It's not bearish. It's not going much lower. It just needs to come back and clean that up a little bit. It went up too far, too fast. This little move right here, this little pop of short covering, it just happened a little too quick for the market. So that's not bearish. So I can get long, right? If I think the market is going to fill the gap, if I think it's going to get to 69.69 and we're down here at 69.57 and I'm like, well, there's no more reason for it to keep going down, that's a place I could get long. What's the upside to it? Well, if the market comes back down through the opening price, which is 69.51, okay, well, then I'm just wrong about the gap fill, right? If the market comes back down right now through the opening price, it's a gap and go, and we're going lower, okay? So I can put my stop below the opening price. So that gives me a good risk reward where I'm risking much less to get into the trade than I would make if the trade worked. But now let's say the trade doesn't work. Let's say I'm wrong and I get stopped out. Well, the fact that I'm getting stopped out, the fact that the market is crossing through the opening price completely changes the probabilities for the day. So sure, I can get long in here and have my stop below that opening price and I'll take on that loss, but that gives me the information that I should be shorting. And I'll probably make that money back on the way down. Okay, so setups like this where we have probabilities in our favor and we have, good risk reward and the trade not working gives us clarity about what the next trade should be. To me, these are the best opportunities the market gives. So I'm always hunting for opportunities like this. My brain is computing what are the odds. Now, let's say I go ahead and I put my long order in here. I put my stop in and then the market fills the gap. Well, then I got to get rid of it, right? Because now the probability of the gap fill is gone. So it's not a good buy if we dip back down there again. And so I'm just every minute of every day, I'm calculating what all the probabilities are. And I'm just saying, is there an opportunity to take a trade somewhere within the range of probabilities of what could happen where my reward is much better than my risk? And as long as I do that, I really only have to be right a little less than half the time. I can be right, 40% of the time, and I can still be profitable because when I'm right, I win much more than I lose when I'm wrong. If you guys are interested in learning more about this, you might want to check out marketsandmind.com. I'll be running a workshop in February, and I'll be teaching all of this in depth. So if that's something you're interested in, you should definitely check it out. If not, you might consider joining the brigade. The Pirate Traders Brigade is my private, membership community where we trade together every day. And I do live streams like this where I share my insights for the first hour of every day. So if you weren't ready to sign up for the workshop, you might just join. It's only $20 and check that out. And it'll give you a pretty good idea of what I think the market is going to do each day and whatever, opportunities may pop up in the first hour. So it's important we backfilled the first low volume node, but that second one is still there. That's still a magnet saying, come on, market, we need a few more contracts to trade hands in here. And of course, as soon as those fill, I'm going to want to watch that order flow for a change. Okay, so here's where we're looking for support. This is where we'd be looking for that change in order flow. Remember, it's critical for the buyers to stay above that opening price. They got to stay above 51 if they want to keep this gap fill going. Okay, so price is holding the opening. The next thing I want to look at is the tick chart. That is ticker symbol TICK, which is basically a rough measurement of buyers versus sellers on the actual stocks on the exchange. So now I want to see these ticks come back up to zero. If the ticks come back up to zero, the market can head back up and start filling that gap. If they get smacked down again and they go red, it means that we're going to head back through that opening price and head much lower. Okay, so we're back at zero. That's bullish to see. They are holding the support for now. The next target is 69.69, filling that gap. Take a look at the NQ. Yeah, NQ is just in lockstep with the ES right now. So same thing, almost filled the gap. Didn't quite fill it, so there's still a magnet to get to Friday's low, and they got to stay above the opening price, 25,710. Both these markets got to hold that open if they want to get that gap fill. Because if they pass through the opening price, they will liquidate every single person that's gone long this morning. Dun dun, dun dun, dun 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 dun. Here it is. Moment of truth. Come on, market. You can do it. Got a little bot tug of war here. You can see it in the order flow. They're trying to get participants long and short right now. People trying to front run the gap and go. People trying to get into the gap fill. Ooh, the market's trying to squeeze them both. Okay, so the more time that we spend grinding right here above the opening price, the less bullish it becomes. Why do I say that? Because we already know if we cross through this opening price, we're going to start to liquidate the market, right? Everybody that's been going long, the guy that went long here, the guy that went long here, the guy that went long here, me, everyone is going to get liquidated if we cross through this opening price. And the more time we spend dancing on top of it, the more liquidity, the more stops that are getting put in down there. Everybody that's buying every one of these little dips, they've got stops. And so those stops are fixing to get squeezed if we don't bounce up and out of here right now. And I do mean literally right now. Okay, see how they're exactly bouncing on the opening price? Bounce, 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 exactly on it. They're trying to build liquidity here. ETH says, in saying that we now have shorts coming in and putting stops above this structure, yes, that is true. But if you're a short right now, where's your stop? It's inside Friday's range, right? So the stops for the longs, they're real close. They're right in here. But the stops for the shorts are up here. Because if you're short, your trade could still work. Even if the market comes all the way up and fills the gap, as long as it finds resistance and continues lower, it's still a good short as a gap and go. So shorts have their stops much further from price than longs. So I could see a scenario where the market comes down here, crosses through the opening price, and it starts to liquidate lower, then reverses and comes back up. Or I could see a case where the market holds this, pushes up, gets resistance inside Friday's range, and then comes back down. The liquidity is there. They'll come for it eventually. And right now, we just have to wait until we break away to find out which way they're going first. Generally, the market goes for the closest liquidity, the easiest to grab, which is why I said the more time that we spend here, the more bearish it becomes. Because we're building more liquidity and more liquidity. And it's right there. It's so easy for the market to just poke down and chew that up real quick. So we don't want to keep spending time down here. We want this market to start to drift away from that. The sooner the better. See that? See how everything's getting darker down here? They're trying to push it up. They're trying to stop it from liquidating. And it's not working. They're trying. They're trying to scare price higher. Heart in the house. Good morning to you. Welcome. Arr. Okay. I don't know what the news is, but I have a feeling there's probably going to be some sort of news that dumps at 10 a.m. just because of how exactly they're grinding right on the opening price. This is a perfect opportunity for a liquidity flush, for them to just, the news comes out at 10 a.m., whatever it is, some numbers report gets released and they go, bah, 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 bah. The news bots come in, they clean up that liquidity below. So I would say if you get stopped out, stay cautious because they could turn around and head right back up once the news bots have fully absorbed whatever that's going to be. Okay, so this is bearish. We're now below the opening price. So we're looking for that liquidation. We're looking for the market to start to be like, boop, 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 boop. And it's probably going to happen in 1 minute. There it is. It's liquidation time. So as I said earlier, normally I'd be very bearish right now because this is what we call a gap and go, where the market gets a gap down. It tries to fill the gap, but it can't. And then it crosses back through the opening price. However, the context of today tells me we got to wait a minute or two here and let the bots chop this up before we get bearish. I still think they want that gap fill. So as we cross back through the opening price right now to the upside, this is my least favorite scenario. This is what we call a gap and chop, What is a gap and chop? It basically just means they're going to pass through the opening price over and over and over again, getting people long, getting people short, getting people long, getting people short. As we discussed, building that liquidity. Each time they poke down, people are shorting the market. Where are they putting their stops? Up here. Each time it bounces and comes back up, what are they doing? They're going long the market. Where are they putting their stops? Down here. So they're just building those stops, building and building and building. Everything right now is reading to me like a sideways day today. All right, so here's your lesson to take home, kids. For those of you that are new, for those of you that have been around for a while, you've already heard me explain this a million times. But when the market has a gap, there is only one of three scenarios that can happen. Like 100% of the time, it is one of these three scenarios. One is what we call a gap and go. So in this case, it's a gap down. So the momentum is down. A gap and go means the market either fills the gap and gets resistance and goes lower, or it opens, it can't fill the gap and goes lower. That's a gap and go. Right now, that's what we've got. We've got a gap and go to the downside, which is bearish. Okay. The third scenario is you fill the gap, but then you don't get resistance. You get back up into the previous day's range and there's no resistance there. That is actually bullish, right? It's a sign that this dip cleaned up the weakness and the market wants to move lower. In my opinion, I think we are going to fill the gap at some point today, but that we will get resistance at Friday's lows. Call it anywhere below, say 75. We'll get resistance there and continuation lower. The fact that it's a gap and chop means they're going to pass through the opening price a bunch of times first. So to me, the good trades now, you should have been stopped out of that first gap fill trade by this point. Okay. The next trades are either if the market gets below the overnight low and then it comes back up and there's no resistance there, that's a long to fill the gap. Okay. Or if the market pushes up and fills the gap and then if the market gets resistance, then that's a short to come back down to test the overnight low. I'm like 90% confident we're going to test both the overnight low and we're going to fill the gap today. But at this exact minute, I don't know which first. And that's what's frustrating about a gap and chop. It is really hard to predict which of these areas we're going to get to first. But the good news is you don't have to be in a trade right now. You can wait till we get to one of these areas, then look for what happens next. You get below the overnight low, you get new selling, you're short for continuation lower. You get a look below and fail, you're long to fill the gap. You get up into yesterday's range, you get new buying, you're long to head up to the overnight high, the all-time high. You get up in there and you get resistance, you're short to come back down for the overnight low. You don't have to diddle in the middle. You don't have to do business right at the opening price. Now, there's nothing wrong with taking one trade, even two trades, to try to fill the gap or to get a gap and go. But if you recognize, as I have here, that this market behavior is the behavior of gap and chop, it is best to stop guessing in here and wait until you get to one edge of the range or the other. That's where the probabilities are in your favor and the risk reward becomes much better. So if you wait for the market to get below the overnight low, it comes back up, it's not getting any resistance, you can get long and use whatever is the current low as a stop. Same thing if you get into yesterday's range, the market pushes up in there, okay, gets resistance and comes back down, you can get short using whatever is the high as your stop. And when I say use it as a stop, I mean a point or so above or below, right? Never right at that level. Because the market loves to do poor highs and reverse at exact levels. So your stop's always a little bit above or a little bit below. But for now, unfortunately, folks, this is chop, gap and chop. So there is no clear edge at this exact moment. With that, I will say goodbye. Wish you guys the very best. If you are not a member of the Pirate Traders Brigade, there's a link written up at the, well, it's not a link, but the address is written up at the top of the screen. It is piratetraders.io/join. $20 a month. You can come hang out every single day. Speaking of which, if you're a member of the brigade, head on over to the private stream. Let's set sail. Thank you, everyone. We'll see you next week.